Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Thursday. It's February 9th. It's about 7:52 in the morning. The market's going to gear up to open up in about an hour and 38 minutes to be as specific with you as possible. Now, as you can see here, the NASDAQ is up about 133, not random. Dow's up 200 points. But remember, we went pretty south yesterday. It wasn't a pretty day for the market. And again, I hate to say I told you so, but if you look at the QQQ, which we will be looking at right now, you will see, let me just show you how the trend is moving lower, and it looks like we're consolidating right around these parts. So to me, it looks like we're going to fill this gap and come back down. Matter of fact, if you look at consumer discretionary, which is one of the sectors that's involved in this, we're already sitting at the 200-day line. That's the 200-day line. I changed the color to blue from mustard. It was just too ugly. And XLC, as you could see here, is also looks like it's coming off, and it looks like it has just another, I don't know, let's see here. The low here was 56.28. The high was 56.14. It looks like we're just a few ticks away from filling the gap here. And if we do fill the gap, I think we're going to end up right here at the 200-day line. Now, I want to show you something interesting. Look at the Dow Jones right now. A lot of folks were asking me where do I think the Dow Jones is going to go and why the sector rotations have been so non-eventful lately. Well, look at the Dow Jones for the last, let's see here, since November. It's been doing nothing. And I mean, this is the broad market, right? The Dow Jones, right? When people say, how is the Dow doing? Well, we've been literally at 34,000, between 33 and 35,000 now since November without any movement at all. But the part that bothers me the most here is if you look at momentum levels on the Dow, and if you look at the number of stocks trading above the 50-day moving average, that number is declining. It's 49%. It's going down. And the number of stocks above the 200-day moving average is going down too. Let me show you what I mean. The graph is not getting higher. It's getting lower. You see that? Here's a better way of looking at it. So you could see here that we're on a down trajectory, not on an up trajectory. We're now trying to claw back into all the gains that we saw in the past couple of months. So the market's cooling off, and this is coming down. And as this comes down, I'm expecting the number of stocks in the NASDAQ 100 and in the Dow to start going below 50%. That should start happening. Look at the Russell 2000. You've got 57% of stocks trading above the 200-day moving average. That's not a strong market. I mean, you've got consumer staples with 24% below the 50-day line. Utilities, 10%. Those are assets that look like they're overdone to the downside. Meanwhile, you've got communication services with 80% trading above the 50-day moving average, and it's declining now, but only 52 trading above the 200. Let me show you what I mean. See that? It's coming down now. Let's go short term. It's coming down. It's coming down. So momentum levels are cooling off, something very, very important. So right now in a distribution aspect of the market, and that's one of the reasons why I'm laughing and looking at communication services and technology, and I'm seeing them up here. Meanwhile, I'm seeing consumer discretionary down here. Folks, think about this. Apple, Amazon, is it technology or is it consumer discretionary? How about Google? Is Google consumer discretionary, or is it technology, or is it communication services? Well, it's actually communication services. But you see, the problem is these three sectors, they're very interwound. They have the exact same type of stocks. I don't even know, honestly, I don't even know why Google's a communication stock. To me, it's a technology or a consumer discretionary stocks, but I don't make the rules. So to me, these two sectors look like they're really, really overdone to the upside, and they need to start coming down. And I believe this fragmentation you're seeing between the consumer discretionary, communication, and technology is just really, really crazy right now. And it will definitely need to cool off before we start seeing more upside in the market. It's just overdone. Furthermore, we've got jobless claims coming out today. Jobless claims data is coming out. I'm not expecting anything crazy. Last week, the number was super, super solid. Just to give you an idea, I think the number's right around 200,000. 220,000, 180,000. This thing has been rock solid. So not expecting anything major there. The big news right now is with earnings. Disney reported yesterday. I'll get into the whole nitty-gritty in a minute, but Disney reported they have some good news. The stock is up overnight. But you have other companies like AVB, like CME. A lot of that will be digested in today's market session. But today, oh boy, you've got PayPal, a tech stock. You got AbbVie, big healthcare stock. You've got AstraZeneca. You've got Borg Warner. You've got Cloudflare. You've got Duke Energy, Expedia. I can't wait to hear Expedia and whether they're booking trips or not. You've got Hilton, a lot of the consumer discretionary stocks, Global Payments, Lyft. You've got Motorola. You've got Ralph Lauren. That'll be interesting. I wanted to buy this stock. I forgot if I wanted to buy or sell the stock, but I was looking at it yesterday and I saw it was earnings that were on it. Tapestry's coming out. That's Coach. Under Armour. So a lot of retailers are starting to come out, and retailers right now is a big question. And then tomorrow we have a small earnings flow. But again, a lot of earnings are coming out today. We're still looking at the market. If you're looking at the market as a whole, just want to do this earlier before I get into the nitty-gritty. You will see, let me just move this back up here. You will see here that this is struggling. The Nasdaq is struggling to stay above the 200-day moving average. And also, it's coming off of great overbought levels. So we might get some gyrations in the next couple of days, but overall, I see this moving lower. As far as the SPY is concerned, let's look at the SPY. The SPY is also just a bit above the 200-day moving average. It's doing everything humanly possible to trick investors and traders like you into thinking the market's going bullish again. Look at this run-up we had, but we're not. We're still in a downtrend. And unfortunately, there's absolutely no end in sight, especially after I tell you what the Fed is talking about right now. So let me just give you some ideas of what we're dealing with right now. Market participants digested hawkish statements by multiple Feds. We'll talk about that in a minute. Now, here's what gets me. U.S. sectors were weighted down by losses in communication, technology, two very speculative sectors, right? Makes perfect sense. But then utilities. Now, why would utilities get knocked out with communication and technology? That just tells me how fragmented the market is. Three major indices were under pressure as the Federal Reserve officials continued to stress the need for more interest rate hikes. Not the party's over, we're going back to the old times. No, more interest rate hikes. Weakness in technology stocks wounded the overall market as Alphabet dropped more than 7% after its new AI chatbot, Bard, delivered inaccurate answers in an online advertisement. Ooh, that's bad. Oh, that's not good. That's not good. Now, here's the interesting part, and here's the part that I wanted to talk to you guys about. So before you get too excited about Powell and what he's been saying, let me just say this. Federal Reserve Christopher Waller said Wednesday, the battle to reach the 2% inflation target might be a long fight. Does he sound like it's going to happen tomorrow? No. And interest rates can go higher than some expect. That's just the bottom line. How about this? John Williams said the Fed has more work to do on inflation, but financial conditions look broadly in line with central banks' outlook on policy. Okay, well, central banks said that we're going to go to 5.4. Not 4.8. So that means he's basically saying we've got more to go. In addition, the Federal Reserve Governor, Lisa Cook, said more interest rate increases are likely needed to reach the 2% inflation target. She emphasized that inflation remains unacceptably high and requires more action from the Fed. I don't know how many different ways they need to tell you this, but interest rates are going higher, not lower, folks, for a while longer. On the earnings front, Disney, the big black mouse, rat, I call him the big black rat, came out with earnings 6% in pre-market trading. They're up. People are happy. They beat expectations, and they announced 7,000 jobs from its local workforce will be cut. That's investors and took that as a positive sign because that means there's going to be 7,000 less people getting paid, which means the company will be able to keep more money for the shareholders. At least that's how they're looking at it right now. Mattel, the game maker, sank more than 9% after the toy manufacturer reported weaker than expected fourth quarter results. Speaking of fourth quarter results, Philip Morris, PayPal, Pepsi-Cola, AbbVie. Oh boy, you've got a lot on the docket today. And jobless claims, the expectation's 183,000. And as I already mentioned to you, there's nothing interesting, exciting, or sexy about this number. It's been rock solid. So not expecting that to be a headline today. Europe data on Thursday showed Germany consumer prices rose 8.7% in January, below their expectation of 8.9%, and a 1% on the month, stronger than expected. I guess that's medium, nothing really great. China closed today higher as investors bet on a rebound economy activity after the country relaxed most anti-COVID curbs, and everybody seems to have forgot about that balloon that was shot down over the U.S. We don't talk about that anymore. State media reports indicated that the People's Bank of China injected fresh liquidity into the economy this week, with investors' attention shifting to Chinese inflation data due on Friday, which will tell us really if there is a rebound activity. In terms of pre-market opening players, anything that's up right now, you got APP up 29%, crazy. Robinhood is up 5%, nothing really crazy. Nothing really earth-shattering, but I think we're going to see some volatility today because, as I've said, you've got PayPal, Philip Morris, PepsiCo, AbbVie. They're all reporting today, and those are big companies. Looking at the bond market, the bond market is now coming back higher because, well, it's rallying because the markets are weaker. Now, I don't like the fact that we're in this range, but I think we're going to stay in this range for quite some time. My suggestion right now is to keep your powder dry on bonds, and if we have a very sharp rally taking us from the 106 level to the 110 level, I think we need to sell it, but we're not there yet, and we're going to keep an eye on it. Speaking of market sentiment, looking at volatility, it's now starting to rise a little bit, as I told you it would, but here's the interesting part. See how it gets shaked out right here? That's algos. That's algos, folks. I'm telling you right now. Usually in the old days, it would stop right here. But no, it gets shaken out and then it goes higher. But I think volatility will rise because the markets right now are set up for some downside pressure. Speaking of downside pressure, in terms of vulnerability, communication services is definitely vulnerable. Technology is still holding on, but we've got PayPal today. Let's not hold our breath there. Financial still looks okay. Real estate doesn't look too bad. Looks like it's having a nice little soft landing. I think consumer discretionary's got more downside to do. I think energies are going to be choppy for quite some time. Industrial is looking good. Utilities are not. Consumer staples are still not. And healthcare is not. But I'm liking industrial. I am liking basic materials and financial. And that's about it right now. Be very, very, very cautious. This is a very interesting point. Why? Let me explain. We've been moving higher ever since November. We've been just moving higher on technology. And there's so many guys that are and gals that are so bullish right now that when the bulls are moving at 100 miles per hour, it takes a minute for things to change course and sentiment to change. And it's happening right now, but it's slow. It's slow to... These traders who bought all the way up here are very slow to admit that this may be a turning point. So once it gets bleeding, it'll start bleeding. But right now, investors have to psychologically prepare for that. Now, today's Thursday. And what does Uncle Roger do on Thursday? I give you my favorite ETF and option pick. Well, I'm going to stick with financials, all right? I'll tell you this. Financials look good and industrial look good. And real estate looks okay, but I would stick with financials right now. Speaking of financials, let's go to financials. XLF. Nice little breakout there. I would go with the options that are expiring. I wouldn't go 37 days. Too close. I would probably go 72 days. And there's tons of open interest. Look at open interest and liquidity. I mean, you can go financial for like $1.22. But again, be cautious right now because I think we're going to have a downturn. So be very, 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 very cautious. There's huge vulnerability and risk, in my opinion, right now. And momentum levels are starting to feel it. So be very, very cautious. This is a period where kind of taking a back seat or maybe getting a little short or just kind of lowering your exposure may be the best idea. I know we were a little early to this shorting party, but usually we're right and momentum levels never lie. Now, folks, you love a good bargain. I know you do. And if you don't, everybody likes a good bargain, right? I'm going live today at 1 p.m. Eastern time to reveal a brand new way to trade And it has to do with ignoring a stock's share price and focusing entirely on the option value. We're doing it backwards. So we're identifying a pricing mismatch where even a small 1, 2, 3% move can lead to gains as high as 30, 40, 56%. Our first closed trade, we got out at 60.9% in 24 hours. Once you learn how to use this information to your advantage, you'll never look at the markets the same way again. Click the link below. Sign up for my live class. This may be the last time you get a chance to see this live. I don't want you to miss it. Remember, it doesn't cost anything to attend. You guys are going to love it, and you'll discover a pricing mismatch in the markets that will shock you. It will shock you. I'm telling you, you're going to love it. And if you already attended, attend a second time. I'll do a Q&A answer session afterwards. We'll answer all questions. No stone will be left unturned. It'll be fun, and we'll have a chance to spend some time together. I'll see you guys later. Have a great day. Bye. And remember, post some comments and feedback in the YouTube channel. I read and respond to them there. And if you have questions, support@marketgeeks.com. Bye.